let's simplify it, okay? I remember years ago when you were at the AFR, you were the chief economics editor, I think, at the time, and you used to do a table once a month just before the Reserve Bank met, and then you had columns. And the columns were rise, steady, or reduction. In other words, rise in interest rates, no interest rate change, steady, or a reduction in interest rate. That's reducing interest rates. Then in your rows you had GDP, inflation, unemployment, international affairs or things that affect international, price rises, etc. Commodity index for Australia, which is really important. Housing costs, etc. The state of the housing market, and you used to put a tick or a cross based on the data that was out at the time. Now, I just thought we might do that again, and maybe you could just put ticks and crosses because to me, I don't think I used to check this every month, and I remember saying to Sean Armour when he was the boss there, I said, Sean, Koukoulas never gets it wrong. Every time you did it, you got it right.
Do you know what, Mark? It's a simple thing. It was the monetary policy checklist.
Yeah.
So you had a checklist of items, and sometimes the items change. You might put in, I don't know, things like motor vehicle sales or the level of the Aussie dollar. But basically, these items here, GDP, inflation, unemployment, international affairs, commodity prices and housing, pretty much capture what the RBA is targeting with its interest rate changes. And it was always, what are the data telling me? Not what I'm thinking will happen, but what's
the current data?
What's the current data in the bank telling me about the economy?
Okay, let's look at GDP. What would you say?
It is
GDP?
strong. On the back of, if your GDP was the only indicator you had, you'd be looking to hike rates.
Let's put a cross against steady and a cross against
you wouldn't
reduction.
You wouldn't keep them steady, nor would you cut interest rates. Because GDP is currently above 3.5%, way above the speed limit for the Australian economy.
So people need to know that speed limit. We're talking GDP. The government the RBA and the Treasury like to see somewhere between 3 and 3.5%.
Ideally, and we're at the top, or above the top end of that right now.
Yeah, right. So the last read on GDP came out was
June quarter 3.6 year on year,
Yep.
and the quarterly momentum was showing not really any sign of a slowdown.
So that's a tick. Okay, let's look at inflation.
Higher rates because of GDP.
Yep. Inflation.
Inflation, easy. That is, can I do 2 ticks?
Yes.
Because that's currently at 6.1% in annual terms.
Yep.
The target's 2 to 3. So we're double the top end of the target range. So if inflation is the key indicator, the RBA is hiking, so that's a rise in interest rates. Certainly not steady. Certainly not a reduction. So that's why we're in the middle of a rate hiking cycle.
Unemployment.
Unemployment. Look, do you know what, Mark? This is the thing that I found really interesting in the last few monthly labour market readings. Employment fell 40,000, only rebounded 33. So 2 months was slightly negative. Unemployment rate was 3.5, 3.4, 3.5. It stopped falling. And so I'd be moving unemployment. Look, you'd possibly keep it in rise, but it's sort of, I'm going to have a bet each way here. I'd have it in the middle between rise and steady because we know labour market and the unemployment rate's the last thing to move in any interest rate cycle. The fact that we've got 5 rate hikes in the bag already, and the fact that we haven't had any job creation for the 2 months, if you average them out. The unemployment rate has stopped falling. Things like job vacancies are topping out a little bit. I'm going to move that to rise steady on the border. Certainly you wouldn't cut rates because unemployment's still nice and low.
Right. International affairs. So what's going on in the world?
Well, gosh, you know what? I would have them, if you're just looking at the international field, you'd almost put that towards reduction. I'm looking at the fact that the US is hiking. Now, you might think, oh, gee, if the US is hiking, all the other central banks are hiking, why haven't you got that in the rate rise column? It's because we know that those economies are slowing.
And they started earlier than us.
And they started early, and they've got them high. The US Fed funds rate, the same as our cash rate's 3.5%.
Right. It's 1% more than ours.
Yep. And so their economy's on the edge of recession, genuinely on the edge of recession. So is the UK. So is the Eurozone. There's the Russia-Ukraine problem still causing, a huge disruption to the European economy.
China's doing it tough.
China's locked down still largely. Their what do we call it? The supply chain problems are still there. So if those trends continue, GDP into 2023, this will move further on. We're not there yet.
Yep.
But what is happening here and now today, the stock market's tanking too.
Yep.
People are losing wealth. They're losing the shirt off their back almost. The Dow in the US is down 20% from the peak. It's a real bear market. So I'd have international as steady and maybe inching towards a reduction.
Commodities, the index. So just explain the
Yeah.
commodity price index.
Okay, commodity prices. Yeah, we know a lot in Australia about commodities. We're a very important commodities producer. Our mining companies, iron ore, LNG, gas, coal, copper, these sorts of things. We're a big producer.
Nickel, wheat.
Lithium even.
Lithium.
Then you throw in wheat. Then you throw in wool. Then you throw in
Beef.
beef, cheese, dairy, all that sort of stuff. What the commodity price index does is get the weighted price in US dollars converted back to Aussie dollars, and it gives an indication of how much money, I suppose, our companies that export are actually making. You know, I'll take a step back. We referred back to the recession we had to have in the early 1990s. I'm old enough to remember in 1986, Paul Keating, again, colourful with his language, said, we're going to become a banana republic.
Yep.
And that's when commodity prices were through the floor. I think the iron ore price back in that day was $2 a tonne. It's $100 today. So when I look at this right now, okay, we've had a commodities boom, but they're coming off. Look at the oil price globally. Look at timber prices, an important part of housing construction. Look at copper prices. People call Dr. Copper. It's the barometer of what's happening in the global economy. I'd say on commodity prices, you'd sort of say steady to a cut. Look, I'll be bold. I'm going to say if commodity prices were your only indicator of the economy, you'd say, gee, for Australia, we're heading for a tough 2023 because iron ore's below $100 a tonne, oil prices below $80 a barrel, copper prices are falling, even our agricultural product prices are starting to decline.
So okay, and then finally housing. The state of the housing market, and that sort of goes to business confidence, consumer confidence, a whole lot of stuff. Because if in Australia, if you don't feel like your house value is up, in other words, you're not making a shitload of money out of your house, you tend to spend less.
Yes, and we've had prices.
The wealth effect, the so-called wealth effect.
Yes, and we know that from CoreLogic, the peak to trough currently, the hard data is about minus 5%. Sydney's about minus 9%, I think it is, the last reading. And we've even seen Adelaide and Perth, which were resilient, they've rolled over now.
And the Reserve Bank had some words to say about it last week.
Yep, and based on their figuring, they reckon with a 2 percentage point increase in interest rates, they've already delivered 2.25, by the way, they would see other things being equal, they would see a 15% fall in house prices. So we're sort of a third of the way there, and Chris Joy may well be right. He may well be right. We'll see in the next few months. But on this checklist, look, the RBA is not unhappy with falling house prices, particularly when they went up 25%. So I'd say here and now, I'll put that in the steady column, but with a risk that in the next couple of months, if we get monthly declines of 1.5% by, say, Christmas, I'll move that into the reduction column. So you add up these things, you've got sort of 3 ticks for rises, 1 for a reduction, and you've got 1 plus 2 halves, so you've got about 2 in the steady column. So you add them up. Well, what's the bias? Another rate rise is the bottom line of my monetary policy.
But it sort of tells us, Steve, there's not too many more in the system.
Yes. And this is the critical thing, Mark. I think you've hit the nail on the head. Well, on the housing issue, as we said, so the RBA will probably hike next week. I'm going for 25 basis points, not the 50, because they can see this evolving right now. But in the next couple of months, it might not be the next time we meet, but it might be our December get-together, I reckon housing may well be into the reduction side. I think commodities will stay in the reduction side. International, I think, might be moving that direction. So we're all moving from either rise to steady to reduction. Unemployment might still be steady because I don't think we're going to get a blowout in unemployment. I just don't think we're getting that improvement. Inflation will still be a problem. Yep. So that stays in the rate rise cycle column. And GDP, we're probably going to get some sort of slowdown coming. We know that consumers are spending a little bit less than they were a couple of months ago. So I'd probably move that slightly there. So this is the speculative part as opposed to the hard facts. I reckon we're in the early stages of the RBA thinking, well, hang on, we've got a lot of rate hikes in the pipeline. We've got our checklist showing, we've got a couple more hikes to deliver, but by the time we get to December, which is the last board meeting of the year, they take January off. We'll revisit it in February. I reckon by the time we get to February, our checklist here will have most of the items in steady. Probably inflation will still be in the rise column, but the other things will be in steady or reduction, and that means they're on hold. And that means that the bottom line, you've got rise, reduction, most steady, you do nothing. you leave them on hold at, that might be 2.85, might be 3.1%, something like that.
So I want to call this the monetary policy checklist.
The checklist, yes, agree, Mark. Yep.
And if you and I had done this in April,
yes,
all the ticks would have been in the
tick would have been
column.
there. The tick would have been there. The tick would have been there. International was booming. Commodities were high.
Yep.
Yeah, that's when the oil price was 130
Housing was
bucks,
out of control.
and housing was going up 25. And that's why they hiked in May,
Correct.
June, July. And then just slowly. And this is an evolutionary thing.
Yeah.
So people say, "Oh, you've changed your mind." So, no, I haven't changed my mind. The data's changed. So when the information changes, like a year ago, house prices were going up 20% year on year. Now, year on year, they're small minuses, and as we said, -5%. So that's changed. The world's changed for housing. Commodities. There's a wonderful chart. If you just Google CRB Index, Commodities Research Bureau Index, CRB Index chart, you'll see this chart of commodity prices. It went up and it's coming down. Worth a look if you've got a spare minute.
Yeah, so and that's interesting because it went up pretty hard after 2010. And and especially in the last couple of years, like during the COVID period, went up
commodity prices
ridiculously.
Yes,
but it has started to come back down.
Correct. And the supply chain problems are easing too. This is a bit, I guess, viewers of this probably or listening to this might think, what do international shipping freight rates mean to me? Well, as an economist who looks at global inflation pressures, we know that one of the supply chain problems that sort of emerged during the COVID lockdowns were shipping rates went up by 5-fold. So anything that you import that went in a shipping container, the cost for the person importing those items, and Australia imports a lot of furniture and products and all the clothing and all this sort of stuff. The shipping costs went up, and that was passed on to you and me as a consumer.
Yeah, they went up 500%.
Correct. And the critical thing now, Mark, and I'd almost include this in the commodity cycle, it's down about 60% from
So
that peak.
freight costs are down by 60%.
Freight shipping rates
Yes.
have fallen sharply. They're still falling because two reasons. The world economy is slowing, so there's not as much shipping going on, and the shipping companies added more capacity, so there's more ships sailing around the oceans.
See, we all get a bit carried away about how complicated, and it is complex, but it's not complicated. When you do it like this, it makes complete sense as to what part of the interest rate rise cycle we're in.
Yes, and as you said, if we were here in February, March, or April, everything would have been in the rise column, and the actual level of interest rates, remember back then, was 0.1%.
Yep.
So the official rates were coming from basically nothing. Everything would have been in the rise column. Easy. Now that we're in this transition, it's getting a little more complicated, and that's why the markets are fickle. They're unsure about what the RBA is going to be doing.